Welcome to KPMG's podcast on ASU 2016-07, Simplifying the Transition to Equity Method of Accounting. This accounting standards update was part of the board's simplification initiative. The objective of the simplification initiative is to identify, evaluate, and improve areas of GAAP for which cost and complexity can be reduced while maintaining or improving the usefulness of the information required to be reported by an entity. My name is Casey Miles, and joining me today is Tony Gahn. We are both senior managers in KPMG's Department of Professional Practice. The FASB initially added this project to their agenda to reduce cost and complexity on two specific aspects of equity method accounting. Tony, to start us off, why don't you walk us through the equity method accounting complexities that the board was hoping to address in this project?
Sure, Casey. As you mentioned, there were two issues. The first issue relates to basis differences. Under current GAAP, an equity method investor has to determine the acquisition date fair value of the investee's identifiable assets and liabilities as if it were acquiring the investee in a business combination. The investor's proportionate share of the individual differences between the acquisition date fair values of the assets and liabilities and the investee's carrying amounts comprises the basis difference in the investment. Investors then must account for the basis difference like the investee was a consolidated subsidiary. On this issue, stakeholders told the FASB that it was costly and complex, and there were doubts about whether it was improving the usefulness of the information provided to the financial statement users. The second issue is retroactive application of the equity method. Currently, when an investor increases its level of ownership interest, triggering the use of the equity method, it has to adjust the investment, results of operations, and retained earnings retroactively as if the equity method had been applied during all previous periods in which the investment was held. To do so, the investor needs to retroactively perform a fair value allocation as of the initial acquisition date. Stakeholders told the FASB that this, again, was costly and very time-consuming without necessarily providing a clear benefit to the financial statement users. So to deal with these two issues, the FASB proposed to eliminate these two aspects of the equity method of accounting. Casey, maybe we can talk about what the feedback was on these two proposals.
Sure, Tony. So with regards to the first issue, which is the basis differences, some constituents raised concerns that eliminating the accounting for basis differences might actually increase cost and complexity in some cases and lead to an increase in the frequency of impairments. This would result in less useful information for financial statement users. The board put this topic on its agenda for further discussion, and in May of 2016, the board discussed alternatives for improving the equity method of accounting based on the feedback that they received. But based on that feedback, the board concluded that there was insufficient support to change the equity method of accounting, and ultimately the board voted to remove the project from its agenda. With regards to the second issue, which is how you account for an increase in the level of ownership interest or degree of influence which triggers the equity method of accounting, the board ended up affirming this proposal based on the feedback they received, and they ultimately issued Accounting Standards Update 2016-07. Tony, why don't you walk us through the mechanics of how the ASU changes current GAAP?
Sure, Casey. So under current GAAP, if we have the example on the slide of date 1 and date 2, with date 1 being the acquisition date and date 2 being the date that you transition to the equity method of accounting. On date 2, when the transition to equity method accounting occurs, the investor has to go back and do a fair value allocation to the assets and liabilities of the investee as of date 1. They then have to recast their financial statements to show the investment as if it had been accounted for under the equity method the entire ownership period. After the ASU, the FASB has eliminated the requirement to go back and retroactively adopt the equity method of accounting, and instead simply adds the incremental cost to the basis of the investment and accounts for the investment using the equity method on a go-forward basis. In addition to reducing the complexity, the amendment also improves consistency with IFRS, which does not require a retroactive adjustment when an investment becomes qualified for the equity method.
The amendments in 2016-07 also require that an entity that has an available-for-sale security that becomes eligible for equity method of accounting to recognize the unrealized holding gain or loss and accumulated other comprehensive income through earnings at the date in which the investment qualifies for use of the equity method. The FASB's new standard about classification and measurement of financial instruments eliminates the classification of equity securities as available for sale. Because of this, the accounting for unrealized gains or losses on available for sale equity securities when the investment qualifies for the equity method is really only a temporary issue until the relevant provisions of the financial instrument standard is effective, which at the earliest would be for fiscal years beginning after December 15th, 2017.
So Casey, to transition to this ASU, first of all, the board affirmed the proposal that the changes would be applied only prospectively to increases in ownership level or degree of influence occurring after the effective date of the change. The board also affirmed the proposal not to require that entities provide disclosures in this period that the change is adopted. For effective date, the board decided all entities should apply this update in fiscal years beginning after December 15th, 2016, including interim periods within those fiscal years, although entities will have the option of early application. So that's all we have planned for this topic today. We thank you for listening. For more information about this and other FASB developments, please visit the KPMG Financial Reporting Network page. And for CPE opportunities, please head to KPMG Learning for courses on a wide variety of topics.